And here's the reality of what an inheritance feels like. It doesn't normally feel like a windfall. It usually comes wrapped with some grief, some complicated family dynamics, but also some quiet pressure to decide to do something.
Grief brain is real, okay? And for any people who've experienced it, you know what that paralysis feels like. Researchers call it bereavement-related cognitive impairment. And so decision-making during this period can be measurably impaired.
So in most states, they deem inheritances to be separate property, not a marital asset. And this is really important because that means that this asset belongs to you. It is not a marital asset, even if you are married.
And then we love this one, a trusted friend or family member who is not asking you for money, they're not charging you for their advice, but somebody really to provide emotional support, give you someone to talk out frustrations with, talk out concerns with, who is there to support you through the process.
Hello, welcome back.
Hello, so good to be here with you again.
Great to be here with you too. Episode number 97. Welcome back, everybody, to Living Richly with Curo. My name is Ann McCabe. I am the CEO and a partner here at Curo Private Wealth. And I'm joined, as always, by my lovely partner, Atricia.
Hello, I am Atricia Roberts, COO and partner here at Curo. Thank you for checking us out for the first time. If this is your first listen, and of course, to all the OG Curo podsters, thanks for coming back.
I like that. OG Curo podsters. We need like some swag for the OG Curo podsters. I love that. Like a little group, a little fan club.
A fan club per se.
Yes. Well, on that note, if this is your first time checking us out, thank you so much for spending some time with us. We are here to educate, inspire, empower you on your financial journeys. And we've decided that the theme around Curo for May is around legacy and inheritance. So today, we're going to be talking about the really important topic of what do we tell clients before they touch their inheritance, okay? And here's the reality of what an inheritance feels like. It doesn't normally feel like a windfall. It usually comes wrapped with some grief, some complicated family dynamics, but also some quiet pressure to decide to do something. So the window between when you find out about the inheritance and when you actually decide to use the money for something is oftentimes the most important window in the entire process. So today we're going to talk about what are the 5 things that we tell clients before they touch their inherited money, and also some of the common mistakes that we see people make so that hopefully our goal is our listeners and viewers will not make the same mistakes if you find yourself in an inheritance situation.
Yeah, of course. This one is a bittersweet kind of topic, but I think it is a good topic to review because it's often hard to think about the inheritance when so much emotion is wrapped around it, right? And so for a lot of people, inheriting the money, it's not a lottery moment, nor does it feel like it, right? Like to Ann's point, it's not a windfall. It doesn't feel like a windfall kind of a moment. There's a lot of things that come with it. But the thing to remember is to give yourself the permission to wait, right? And to take a second until you are ready. And then when you are ready and you have a plan that is organized, then you just take it on step by step.
Nice and easy.
Yep.
All right. So we're going to talk about, first of all, why this matters, just sort of set the context for you. So in case you have never heard of this, there is a great wealth transfer coming. And Atrice and I, being in the industry that we're in, I don't know if we had $1 for every time we heard the great wealth transfer.
Oh, we'd be rich by now.
We'd be podcasting from our private island. We would still podcast with you all. It would just be from a different location. But if you are not aware, there is a large wealth transfer coming to the tune of about 84 trillion with a T dollars that will change hands in the United States alone by 2045, which is really right around the corner when you think about how quickly time goes. And the reason that we especially care about this great wealth transfer is that a disproportionate share of the wealth is going to end up in the hands of women, partly because women tend to outlive their spouses. So we need to have these conversations because a lot of women have never sat down to understand and have not been walked through really their inheritance and how it actually works. So, what we find is that sometimes, not all the time, but sometimes people will do their estate documents, which is fantastic. This is something we talk with clients about all the time is getting their estate documents in order, and you'll get the, pretty fancy estate planning binder. But beyond that, the conversations around, okay, well, what happens when my loved one passes away day one and what happens on day 90, those conversations don't tend to happen. And so the result is that smart, capable women feel stuck at the exact moment that they also feel like they're supposed to make decisions. And oftentimes that can lead to rushing into a decision without all of the information, rushing to an emotional decision that can later end up in regret. So we don't want you all to experience the regret that we have heard people share with us. So again, this conversation in this episode is all around some of the points to think about before you make decisions and some of the common mistakes that we see ahead of time.
Yeah. So the first tip we want to suggest is to pause, right? We often advise don't do anything for the first 90 days, right? And it's really because a lot of what we hear about the woulda, coulda, shouldas was about decisions that should have been made early in the process. So we recommend that you give yourself 90 days before making an irreversible decision, right? So just let it settle. Oftentimes, you're also dealing with the emotions that come along with inheritance. So giving yourself that pause can be a big relief. That means don't make big purchases. Don't quit your job, even if it's a what we call life changing amount of money. Don't pay off any major debt just yet, like your mortgage. Don't make any joint account moves. Don't make any major gifts, right? So, nothing major in those first 90 days. Grief brain is real. Okay. And for any people who've experienced it, you know what that paralysis feels like. Researchers call it bereavement related cognitive impairment. And so decision making during this period can be measurably impaired, right? In that first 3 to 6 months after a really substantial major loss. So that's biology, right? That's science that says that this happened. It doesn't mean that you're weak. It doesn't represent a sign of weakness. And it's not the same as most financial decisions that feel most urgent. So you just want to give yourself that time to pause. Now, what the pause looks like in actual practice, right? So it is parking, it's not paralysis, right? Little alliteration for you there. So think about it as parking and not paralysis. You want to move money to a safe, liquid spot, a high yield saving, a money market fund, a treasury fund that earns a little, but yet it is fully accessible, and you're not making a long term commitment to anything just yet. So this allows you to honor the person, right, who left you the money by being thoughtful and not being fast to make the decision because there is no prize in moving quickly, right? You're not winning anything from racing through the decision making. So I think this allows you the breathing space to come up with a really actionable plan.
Yes. And when we talk about high yield savings, just to give some numbers, it's,
Mhm.
May of 2026. You should be earning, let's say, at least 3.5%. Is that fair on a savings account, high
Yeah.
yield savings right now?
Yep. I think
Yeah.
that's fair.
Okay. So when we say high yield savings, we don't mean 0.005% in your checking account. We mean like actual high yield savings. Okay. So just wanted to mention that as well. So, second thing we're going to do is we are going to take an inventory of what exactly you inherited because all assets are not equal. So, we're going to go through many of the various assets that you could inherit, the ones that we see most commonly, and explain some things that you need to be aware of in each of these different categories. So the first is pretty straightforward and basic, and that is cash assets. So think those high yield savings we were just talking about, or checking, money market. This is, again, very straightforward and very liquid. Assuming you are listed as a beneficiary, payable on death, transfer on death, that sort of thing, this should be pretty straightforward that it comes to you directly. Second thing we're going to look at is what we call taxable brokerage accounts or taxable investment accounts. Now, usually with these accounts, you will get what's called a step up in basis. And we like to sometimes call it a step two in basis because sometimes it's a step up and sometimes it's a step down. It's a step to whatever the asset is trading at the day that the person passes away. And this doesn't always apply if you have like a trust situation. There could be a case where the step up in basis does not apply, but in most cases, taxable brokerage accounts are going to get that step up in basis. Okay, next on the list is traditional IRA or 401ks. So, if you are a non spousal beneficiary, so let's say you inherited money from a parent, for example, the 10-year distribution rule applies, assuming that the person passed away after the Secure Act was passed in 2020. So, what this means is that 10 years after your parent, in this example, passes away, you have to have the traditional IRA or the 401k fully depleted. The other thing to remember is in a pre tax situation, so think traditional IRA, pre tax 401k, your parent never paid taxes on these assets, which means guess who pays the taxes? You
You
do.
do.
You do. So there is a tax liability built into that asset that, we all, if we're working together, need to be aware of, and you certainly need to be aware of as the beneficiary. Now, Roth IRAs have slightly different rules. You still have the 10-year rule associated with them, but the nice thing about Roth IRAs is when you take distributions, they are totally tax-free, assuming they meet certain qualifications, which most of the time they will in an inheritance situation. So you still want to be aware of the clock that's ticking on the Roth assets. Now let's talk about real estate. This could be family home, this could be a rental, a vacation property. Usually this also gets that step up in basis. So if your parent bought the home for $500,000 and now it's worth a million, that $1 million is the basis that you are and the IRS is really going to use to calculate your gain or any tax impact that may apply. But the sort of additional conversation that has to occur too with real estate is the choice of whether to keep the property and all that implicates, as well as to possibly sell it. You may also have inherited a real estate property with a sibling or with another family member. So that brings in another layer of complexity that we need to be aware of. Next is life insurance. Now, life insurance will typically pass to a beneficiary income tax free. The estate tax will depend on the state and how much the estate was worth, but life insurance will typically pass income tax free anyway. Trust distributions, you want to look at the trust documents to understand the terms and understand what you are allowed to do, what you're not allowed to do, how you're allowed to spend the money, etc. And so, when clients say to us, oh, well, I'm inheriting $800,000, this is one of the first things we want to do is understand what kind of asset we're talking about or what kinds of asset. Because again, $800,000 in a taxable account is going to be a very different situation than $800,000 in a pre-tax 401k. That 800 is really going to be, depending upon your tax bracket, et cetera, closer to, 400 when everything is said and done. So we want to make sure we understand and inventory those assets so that you are clear on exactly what you're dealing with and the decisions that you're making, because you really can't make educated decisions until you really understand what you own.
Right, absolutely. So, as Anne mentioned, there are a lot of different asset types that you would inherit. So, our third point here is to understand the specific tax story about any of those assets. And there are two major ones that we want to point out. So, Anne mentioned the step up or step two in basis, more specifically around real estate. But there also are step two bases for invested equities like stocks or bonds or mutual funds. Those kind of things also get a step to basis. So when someone dies and leaves you that investment, just like with real estate, the IRS is going to reset your basis to the value at the date of death. Now, for investment assets like stocks, bonds, mutual funds, REITs, whatever it is you own in a portfolio, the calculation of that value at date of death is a little bit more complicated than just with property. So you do want to work with an advisor or a tax preparer who has an expertise around calculating that basis for you. But it allows you to also get a higher cost basis on any of those inherited assets. So let's give an example. Let's say you had a parent or grandparent who bought Apple when it first launched, right? The value of Apple has grown so significantly since their original investment amount or their cost basis. So if you, as the inheritor, were to inherit their basis and wanted to sell those positions, you may possibly realize a really big taxable capital gain. By getting a step up in that basis, it gives you the flexibility to be able to sell assets at their current value with a higher basis represented at the time of the original owner's passing. So you can just imagine what that difference would be, especially with lots of these tech stocks like Apple and Amazon. That makes a really big difference in receiving that step to value. So if you inherit portfolio assets, you want to make sure in this 90-day pause that you're making, that you confirm that all bases have been stepped up or stepped to their date of death value appropriately before you make any decisions on what, if anything, to sell.
May I just double click on
Of
that
course,
right
please.
quick, right quick? Okay. So, how many times, Atricia, have we moved over assets from large, reputable financial organizations who assure us that they have done the step up in basis. And when we dig in, peel back the onion, look at the positions, we're like, wait a minute, the date of purchase here is 1995. Our client's parent did not pass away in 1995. They passed away in 2026. So I'm just saying this is super, super important. And just because a financial institution tells you, oh, yeah, like we did the step up in basis, always double check, because you do not, years down the road, if you decide to hold on to a position, want to be digging up tax documents and having to go back into historical stock prices, et cetera. Just make sure that it's actually accurate and organized and ready to go when you're inheriting these positions.
Yeah, absolutely. This
End of my
also,
rant.
no, it's a helpful rant because I think it is also in another, we call it a triple click. Triple click is sometimes these step ups can be a little more complex if the original positions were owned by two people, right? If there were a joint owner and one person predeceased the other, then maybe only a certain portion of the investments got stepped up, the other portion did not. So you just want to make sure that whomever you're working with is really knowledgeable and does the work, to use Anne's expression, to peel back the onion to make sure that basis is reported correctly when you inherit assets. I ran into an issue with a client recently where there was an incorrect reporting by her CPA around the basis of her home when she sold it because her husband passed away, 5 years ago, and it hadn't been reported accurately of his portion of the step up. So it is very important because it makes a huge difference to the tax situation. And so some common mistakes we see around inherited, especially portfolio assets, is holding inherited stock out of loyalty, right? My my parent owned this forever, or we had the original stock certificates. I've gotten that one before, right? Like, we still have the original Disney stock certificates, and you feel so beholden to it. You hold those stock out of loyalty when that may not be the best financial decision for you at the time. So sometimes keeping those inherited positions is right for you, right? Sometimes they actually fit in with your goals. I had clients inherit Amazon stock. I had no reason to advise that they get rid of them, right? But that step up in basis is a pass, right? It's a free pass to liquidate positions with minimal taxable impact and to reposition assets for what best fits your financial goals. So don't just make the mistake of holding the position because you feel beholden to family, right? Or some sense of loyalty of holding the position. So the other tax scenario we want to make sure we point out, and Anne hinted to it a little bit, is about the 10-year rule on inherited IRA accounts or retirement accounts, traditional IRAs. So as Anne already mentioned, the Secure Act 2.0 has very specific rules around non-spousal beneficiaries. But there is an exception for spouses, and we want to make sure we highlight that for you as well. So spouses have different and usually more favorable rules other than like children or other beneficiaries. And so what happens is for most spouses, if they opt, they can choose to take on the IRA as their own. So they don't technically have to have it as an inherited IRA. They can step into it as if they were the original owner, which means that required minimum distributions in the future now are calculated on their life and not the original owners. And so this is its own conversation, right? Recent widows have specific options, and it's worth having a conversation with your advisor about what makes the most sense, right? Do I step into this as my own? Do I treat it as an inherited IRA?
Yeah, exactly. All right. Tip number 4, or what we tell clients, is please keep these assets separate, especially if you're married, and especially in this 90-day time period that we're talking about, but perhaps even after the 90-day period. So, in most states, they deem inheritances to be separate property, not a marital asset. And this is really important because that means that this asset belongs to you. It is not a marital asset, even if you are married. But that protection is fragile and it's easy to lose if you are not careful about the decisions that you make. So, what we see is how commingling, I'll say accidentally, sometimes comes up is someone will deposit their inheritance into a joint checking or joint savings account. So we said at the top of the episode, park the money somewhere safe for the first 90 days while you're trying to figure things out. Please do not park the money in a joint account with your spouse. Again, if you decide to commingle assets after you get through this 90-day period, that's okay. But don't accidentally put it into a joint account and turn a separate property or separate asset into a marital asset. Also, if you use part of the funds to pay down a mortgage that you have together with your spouse on a home that you own together with your spouse, that has now become a marital asset. So we already talked too about mixing inheritance with marital assets, savings, or investments that you already have. So any one of these decisions can, quietly and innocently take something that is a separate asset and accidentally turn it into a marital asset. And so, just to be clear, we're not talking about distrusting anybody. We're not saying that if you decide to commingle your funds, that's a bad choice. We're saying that it's very important to make that decision intentionally. And what we see is that a lot of people make the decision accidentally. They think it's a innocent decision, innocent step, and all of a sudden it's a big deal, right? Because you lose the status of it being a separate asset. So this matters obviously if you go into a divorce situation, if you're in a second marriage, if you're talking about blended families, and also especially protecting kids from, a first marriage. These are all super important considerations. So what we would say is if you don't already have a separate savings account in your own name, this is a good time to open one of those high yield savings accounts in your own name. And this is where we want you to park the money until you can have a conversation where, your spouse is very much in the room and you're having a joint conversation around decisions that you're going to make with these assets and what you plan to do with them, how you plan to use them.
Yeah, I would also add to be mindful of beneficiary designations of these assets as well. For most people who are partnered or married, it's very natural to have your spouse be your primary beneficiary. On inherited assets, you just want to consider if that's how you want the money to flow, especially if you've inherited from parents, right? Is there another sibling or nieces or nephews or even your children that should be considered ahead of the spouse? So just a note about that one as well. And giving yourself the time to wait gives you time to identify how that money should flow if even you outlive the inheritance. All right, so this next tip, our fifth tip, is one we've talked about before. I believe it was in our like what to do after a spouse passes episode of Living Richly with Curo, but this is one that we're always going to recommend. And this is build your team before any big move. Now, you have heard us drone on and on about this, right? Having professionals, having advisors in your corner to help guide you through the process. So you want to think about who should be in the room with you, right, as you're making these decisions. Many women try to figure this out alone, and partly it's because of this idea of, well, I don't want to bother anyone, right? This is not someone else's problem. We love to own it and hold on to it and not ask for help. But the cost of getting this right or of not getting it right could be huge, right? And it's much bigger than getting it wrong would cost you. So here's a team that we recommend: a certified financial planner. You can check the designations at the end of our titles. Look for the CFP with the copyright symbol. So this is going to be a planner who is going to look at your whole picture, right? So not just the investments and the taxes, but they're going to look at your goals, right? What is important to you? What does this money mean for you? And then also the estate plan, in addition to those other things, like I mentioned, what do you want to happen to this money should you outlive it? We are also going to recommend a CPA, a certified public accountant who can run the numbers for the year of the inheritance, especially if there is inherited IRA mixed in. Remember, if you are a non-spousal beneficiary, you have 10 years to get that money out of an inherited IRA account. And if you yourself are already in a high marginal tax bracket, this could have a huge impact on the tax bill you have to write Uncle Sam every year. So working with a CPA helps you create a strategy about how to navigate this. An estate planning attorney should also be a part of this team. So, since inheriting often means that your own estate plan needs to be updated, right? What does this mean for me now that I have these additional assets, which could include property, right? It could include all manners of things. And so you want to make sure that you update your plan to include the new assets that you own. And then we love this one: a trusted friend or family member who is not asking you for money. They're not charging you for their advice, but somebody really to provide emotional support, gives you someone to talk out frustrations with, talk out concerns with, who is there to support you through the process, and they're not sending you an invoice at the end of the month.
So important. So important. All right, so we're going to do a little rapid fire right now around common mistakes that we see and pitfalls that we want y'all to avoid now that you're listening to this episode. So, number one, quitting your job within the first 30 days of receiving an inheritance. Even if you've been noodling this, thinking about it for a while, let's just hit that pause button like we talked about, take a breath, and let's not make a huge life-changing decision like quitting your job within the first 30 days.
Yep. And I've seen it, and it didn't end well. So
no, you can always decide. Yeah, you can always decide to quit your job in the future once you get through the initial, like, very emotional situation. Next is, we don't want you making any huge lifestyle purchases. Okay. So that, new boat, or plane, or second home,
or a sports car,
crazy car. Again, if you decide to make these purchases after, a hot minute, totally fine. But let's make those purchases after we know what you actually have and we have a plan in place for you. Next, we don't want you to lend or gift any money to family members before you have a plan. Please just know that once that money leaves your hands or leaves your bank account, those family dynamics are going to change. And a lot of times you're not going to get the money back. Okay. So even if it's like a loan situation, we've talked about this before. When you loan money to friends or family, you should just treat it as a gift. You should just assume it's never coming back.
On
Absolutely.
This one.
Double click on that one.
It. So one of the other things that I've seen and we want to raise is some people will say, well, I don't want to inherit all this money. I'm going to disclaim it, is what the process is called, and have someone else inherit it. You don't have to rush to make that decision, right? The IRS gives you 9 months from the date of the person's passing to decide if you're going to disclaim inheritance due to you. So I just thought I would tag that on to the family gifting. You may think, oh, my brother needs more of this money than I do. Oh, I want to leave it to a child. You've got 9 months. So it's not a decision you have to make in the first 90 days.
Yeah, so important, especially because, like we talked about, in the first few months, there is a massive amount of emotions and guilt, right? Like, well,
Right,
I don't want this money. This is my loved one. I'd rather have him
right.
or her in my life. So, such an important point. Absolutely. Okay, next, Atricia talked about this earlier, but forgetting to change beneficiaries or to even put beneficiaries on these assets. So if you do end up opening, the high yield savings account as a parking lot, make sure that you've got a POD is usually what it's called on a bank account, a payable on death, so that there is a beneficiary associated with this asset. And if God forbid something happened to you, it would not have to go through probate. So that's really important. Next, just like if you win the lottery, people, keep it to yourself, okay? Like, please, for the love of all things holy, let's not tell too many people too soon, right? Just privacy is a financial planning tool that we use quite a bit. And yeah, again, you'll have an opportunity should you choose to do so to share it with the world if that is what you decide to do. But let's not rush to tell everybody all your business about what's going on financially. And then the last one is kind of like the opposite mistake. So we've talked a lot about not rushing to decisions. We also don't want you to take forever to make decisions. Okay. Like we said 90 days, we did not say 9 years, right? And so, as women, especially, sometimes we have a tendency to feel more comfortable if we just leave our money in cash forever because it's safe, it's secure, it's not going to go down, right? When the stock market goes down. But as we've talked about so many times, if we leave too much money in cash, there is a massive opportunity cost. We are not keeping up with inflation and we are not maximizing our wealth building as much as we possibly could. So, we don't want you to rush to decisions. That is also not permission to not make decisions or wait too long to make decisions.
Yeah, for sure. I'll also double click back to another point we made on a different episode is that, especially if you are married, in the year of your spouse's passing, it's going to be the last year you get to file your tax return as married filing jointly, right? Which has bigger deduction amounts, bigger income brackets. And so sometimes there are important decisions to make within that tax year. Again, we're not saying rush, but it is also, to Anne's point, we're saying that 90 days, not 90 months, right? Because some things you want to be able to take advantage of certain situations before you lose that tax filing status.
Yes, such an important point. So this goes back to having the team, right? Like the professionals that can say like here are the decisions that you can hold off on and maybe if you are going to face like a widower's penalty is what we call it in the industry, let's make some of these tax decisions now so that you can take advantage. Otherwise, you're going to be paying a much higher percentage. So yeah, it goes back to having that team of professionals who you can trust, who can give you that advice of here's what you can hold off on and here's what you really actually do need to make decisions on if that's applicable to you.
Yep. So we want to review just some takeaways. If you don't take anything away, we gave you 5 tips, but here's just 3 things to remember if you don't remember anything else. One, give yourself 90 days. So once you find out that you're inherited money, try not to make any big decisions for those first 90 days. 2, park the money somewhere that's safe and liquid, right? Somewhere where you can tap into it. Side note, be mindful of how it's titled or beneficiaries are designated on that money. And then 3, use those 90 days to take an inventory of your inheritance and to build your team. It's going to be vitally important as you make decisions in the long term.
Yes. All right. Awesome.
Such a
Hopefully this
grim
was
topic,
helpful.
but hopefully it
I
was
know.
helpful.
I know. But sometimes in what we do, we have to talk about these
Yeah.
things. It's the reality of life and we're here to give advice.
Yep. And never underestimate your family's ability to act really crazy about money after somebody passes. Even when you think like, "Oh no, we all understand. We're all on the same page." Be prepared for anything.
This is true. Money
It's
brings out
unfortunate, but
interesting. Yeah, brings out interesting. I always say that I think money just brings to the surface like who you
mhm.
actually are as a person. I don't think it
Amen.
necessarily changes people, but oftentimes if there isn't money involved, the true colors can be suppressed a bit and then
Right.
they are not suppressed when the money starts showing up. So,
Yeah.
it's yeah, we've seen some crazy situations to say the least.
Different episode for a different day.
Yeah, that'd be a good one.
It would.
Craziest things we've heard and seen in inheritance situations. All right, my dear, what do you have for us for a closing thought of the day?
Okay, so this is so random, and I'm sure I've said it 300 times on this podcast, but I ran into this show on Apple TV, and I actually think it came out a couple years ago called Manhunt. And it's about the search for John Wilkes Booth after the assassination of President Abraham Lincoln. Now, I'm watching this series, which is based on a book, learning things about this time in America that I never knew happened. I mean, maybe it was my Georgia social studies education. You know, I went to school and grew up in Georgia. I'm pretty sure there were parts of the Civil War that were cut out for us to learn about. But it was just a very interesting sort of time. But what it reminded me of is as I'm watching this show, is how much of what was happening then feels so similar to some of the things that are happening now, right? Like just the way media was used. It was this big push to, make sure everything was in the headlines, right? There was just this big talk of trying to drive the narrative about what was happening. And so it was always a reminder for me, or became a reminder for me, that history often repeats itself, right? Things often come up again, especially if we don't learn the lessons of the past. That's always a big reminder for me, is that we don't learn the lessons from the things that we've already experienced and use them in a way to inform and change the way we move going forward. We're destined to repeat it over and over again until we get the lesson learned. So it was a good reminder from a high level, but also from a personal level, to just remember that oftentimes the things we go through and we experience are lessons to help us do it differently or move in a different direction going forward. Or sometimes you have to keep reliving the lesson. So I'm trying to remind myself and use that as a reminder to, when I'm going through challenging times, difficult times, to remember the lessons that I've learned and to try to use them and implement them in a way so that I don't have to relive it, right? So that I can do it differently going forward. So that's my thought for today. And
Yeah.
check out Manhunt on Apple TV if you haven't. It's really, really good.
All right. I'm going to add that to the list because you know how much I watch TV. So I'll
Yeah,
probably
I
get to
know.
it in like 2029.
Yeah, I mean, all of my TV is like historical drama or crime
Yeah. Or like
documentaries. I'm
documentaries. I know.
not
Same,
um,
same Z's.
yeah, but that one was a really good one, and again, it just made me realize how much I never really learned about that time in America's history, which is scary because it's probably why we're seeing a lot of the same things happening again,
Hmm.
because a lot of us didn't learn those lessons.
Hmm. Yeah, exactly. What do they say? History doesn't repeat itself, but it rhymes.
It rhymes, yeah, and so we're definitely rhyme time right now
Yeah.
if you
Yeah.
if you go back to that period, and I think I said it again when I was looking, at a documentary about 1968 specifically, and how about
Yeah.
so much that was happening in that time period feels so relevant and present,
Hmm.
and so it's just a good reminder that we gotta learn the lessons and move forward in a different way, or we will just repeat the same cycles.
Yeah. One of my favorite authors who I've told you about multiple times, Ryan Holiday, he's written a bunch of
Mhm,
books about stoicism and
yeah.
he talks about how the best way to understand what's going on in like present day is actually not to read the news. It's
Yeah.
to study history because to your
Right.
point, a lot of the challenges that we face in modern times are very similar to challenges that we faced, and it's important to understand how people reacted and what was the result and what can we learn from maybe how we should have done things
Yeah,
differently last time around.
for sure.
Yeah. Yeah. All
What's
right.
on your
So
mind?
my closing thought I feel like is something that you would actually share as a closing thought. You probably have shared something similar. So you know that I met up with one of my best friends. We met up in Richmond. So she lives down in North Carolina. I obviously live in Northern Virginia, so we met halfway, and we are the kind of friends that like we both suck on the phone. We don't necessarily like talking or texting a bunch. And so we'll go like months without even communicating with each other, but when we get together in person, it is like no time has passed. We've been best friends since seventh grade. I think I met her in sixth grade when I moved up here from Atlanta, but then we really became friends in seventh grade. And it's just every time I see her, it's just such an important reminder of the importance of friendship. Like those friends that you have that are like sisters, right? That have known you through so many different phases and ups and downs in your life, but they're still there for you and you can sit there for hours. We literally were like getting nasty stares from our server because we were
'Cause
like
of the
sitting
laughs,
there.
the cackles.
Yeah, we were sitting there for many, many, many hours. Like we ended up
Mhm.
having to move to the bar. We were like, okay, sorry, like we're not trying to mess you up with your tables. but yeah, just the importance of having those friends and investing in
Yeah.
those friendships. And I know you talk about this a lot because your friends are super important to you. So it was just a lovely reminder. It filled my cup, it filled my soul,
Mhm.
and just reminded that, those people are really, really worth investing the time and energy into.
Yeah, for sure. And to that point, I'm actually, and you know this, I'm actually traveling tomorrow to my godson's high school graduation. Still blowing my mind that my best
I
friend has
know.
a child old enough to graduate from high school. But this best friend, we've been friends since the 10th grade, right? And she's
Hmm.
like the friend that becomes family. And to your point, we don't talk on the phone a ton. She sends me pictures of the kids because she's got a gaggle of children. And so I
Hmm.
get, I get updates, but I'm so excited to just go be around her, right? Just to spend time with her. Because to that point, like we can pick up like we never left. And I
Yep.
love those moments. So I'm so
Yeah.
glad you got to have that and just feel reconnected and invigorated and, spiritually fed to be with your friend.
Yes. Thank you. And I'm
Of
happy for you
course.
too that you get to
Thanks.
experience this mañana.
I'm excited.
So
I mean,
safe
it's I can't
travels.
I can't have her to myself because it's about her son's graduation. So, but
Yeah, but
I've
hopefully
got
y'all can get like a time,
Yeah,
a time that
we're
you
gonna
can
find a
get
moment,
away.
at least hopefully on Thursday, where we can either go to breakfast together or lunch or something
Yeah.
before I leave, so we can just have a moment.
Yeah. And then, of course, you'll see your grandmother. So we expect grandmother
Yes.
stories because she's got the best sayings and stories. Atrisa's going to write
Oh,
a
my
book one
grandmother.
day about her grandmother's sayings. They're amazing.
She called me this morning and she's like, "You're still coming on Friday, right?" And I said, "Well, yeah, actually, I'll be there on Thursday." She's like, "Okay, good, because you need to come by my senior center on Friday." I'm like, "Okay, here we go."
Oh, I can't wait. Cannot wait to hear the stories. Amazing.
Well, I'll update you guys on
Amazing.
the pod the next time we record.
Yeah. There'll be some closing thought of,
Oh, for
a
sure,
wise saying that your
for
grandmother
sure.
shared with you. Yeah. All right, everybody. Well, that wraps us for another week. Thank you so much again for spending some time with us. We hope this episode, like always, was helpful. And until next time.
Live richly.
Thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.